Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Nuscale Power.
If you find our talks useful, please consider subscribe, like, and comment underneath.
Right, so we have a lot to cover today.
We really do. Okay, let's unpack this overarching wealth building theme. We're looking at a setup that's currently flashing a 7 out of 10 bullish investment thesis.
Yeah, which is pretty significant.
Definitely. And it's focused on a company sitting right at the leading edge of the global nuclear renaissance.
The volatility in this space is it's absolutely staggering right now. I mean, anyone watching the market has seen the extreme whiplash this particular stock has gone through over the last 6 months.
Oh, yeah.
It is an incredible case study in, market psychology.
Yeah, our mission for this deep dive is to help you navigate those turbulent crosscurrents. We've been digesting a massive stack of SEC filings, technical charts, institutional research notes.
The whole 9 yards.
Exactly, because when you look at Nuscale Power, you see this violent collision of factors. You've got these terrifying accounting charges and severe legal hurdles on one side.
Right, the bad news.
Yeah, and that's slamming directly into unprecedented government backing and this relentless energy demand from the artificial intelligence sector on the other side.
It represents the quintessential high-risk, high-reward scenario. But, what makes it actually tradable is understanding the mechanics underneath the headlines.
Right. So we always start with the brutal financial realities because a savvy investor looks at the downside first.
Always.
And honestly, at first glance, the recent SEC 10K filing for this company reads like a financial horror show.
It really does. The fourth quarter of 2025 was uniquely devastating on paper. But to understand it, you have to frame the company correctly.
Right. They're not a traditional utility yet.
Exactly. They are in a pre-revenue, highly capital-intensive commercialization phase. They're essentially building the foundation of an entirely new industry. And that burns an astronomical amount of cash.
Even knowing they're pre-revenue, though, the numbers are shocking. The market was projecting revenue of about $8.76 million.
Yeah.
They delivered just $1.81 million. That is an enormous percentage miss. And it came with a GAAP earnings per share loss of 80 cents.
Right.
I mean, if you ran a neighborhood lemonade stand, brought in $1.80 and lost 80 cents, you'd shut it down by noon.
You'd be bankrupt by lunch.
Exactly. And the margin numbers are where people really hit the panic button. We're looking at a negative net margin of 1,130%.
Yeah, that's not a typo.
Coupled with a negative return on equity of over 55%.
So the primary catalyst for that massive drop in the metrics was a staggering $507 million accounting charge.
Just massive.
Yeah, and that was alongside a $495 million cash outflow. This was all related to a milestone payment to their partner, Entra1 Energy.
Let's break that down, actually. Because a $500 million charge doesn't just happen by accident. Entra1 was supposed to be their deployment partner, right?
They were. So Nuscale designs the tech, but they rely on partners to actually commercialize and build these massive projects.
Makes sense.
And when you set up these partnerships, accounting rules often allow you to capitalize certain expected revenues or costs based on projected milestones.
Okay, so it's projected future value.
Exactly. But when the Entra1 partnership stumbled and they missed those crucial developmental milestones, the reality of the situation just no longer matched the balance sheet.
Ouch.
Yeah. Nuscale was forced to take a massive write-down of that phantom future value. It basically showed the market that their partners might not have the operational heft to deliver these complex nuclear builds.
But, applying a bit of market psychology to this filing, we can look at this as the ultimate kitchen sink quarter.
Oh, 100%.
It's a classic move. When an executive team knows a quarter is already doomed, they don't just report the bad news piece by piece.
No, they dump it all out.
Right. They throw every piece of bad news, every write-down, every outstanding liability onto the income statement all at once. They use the cover of a bad quarter to aggressively clean up the balance sheet.
They consolidate the pain. By taking that massive Entra1 charge now, management essentially resets the baseline to the floor.
Get it out of the way.
Exactly. It looks awful today, but it ensures that future quarters aren't bogged down by lingering write-offs. It clears the decks so the next few earnings reports can actually demonstrate sequential growth rather than ongoing stagnation.
I understand the strategy behind the kitchen sink, I really do. But I have to push back hard here.
Sure.
Put yourself in the shoes of someone looking at their brokerage app right now. with negative margins over 1,000% and $500 million written off in a single quarter. How is this company avoiding bankruptcy? Why isn't Wall Street pricing this at zero?
That is the multi-billion-dollar question. And it brings us to the $3.47 billion market capitalization they command despite that intense cash burn.
It seems totally counterintuitive.
It does, but institutional investors tolerate a negative 1,000% margin for one specific reason.
Yeah.
They are funding a monopoly protected by an impenetrable regulatory moat.
Okay, we need to unpack that moat, because this isn't a software startup burning venture capital on Facebook ads.
Far from it. They're the only company in the United States to hold a design approval from the Nuclear Regulatory Commission, the NRC, for a small modular reactor.
The only one.
The only one. And the NRC is notoriously, perhaps uniquely, demanding. Getting a design approved takes hundreds of millions of dollars.
Wow.
It takes countless thousands of pages of engineering data and decades of rigorous stress testing. Competitors in the space, like Oklo, are still stuck wandering through that regulatory maze, just having their applications kick back for more data over and over.
So that approval is essentially an absolute barrier to entry for anyone else right now.
It grants them the ultimate first-mover advantage. The technology the NRC certified is their VOIGR system, which revolves around 77-megawatt modules featuring passive safety systems.
Passive safety is such a fascinating engineering concept. My understanding is that traditional nuclear plants rely on active safety.
Right, active intervention.
Yeah, so if something goes wrong, they require massive diesel-powered backup generators to pump millions of gallons of cooling water into the core. If those generators flood like we saw at Fukushima, the core melts down.
And that vulnerability is exactly what passive safety eliminates. The VOIGR system uses physics instead of active machinery.
How does that work?
Well, the valves holding the cooling water back are held shut by electricity. So if the grid goes down or the facility loses all power, those electrical locks simply release.
Oh, so power loss is the trigger to be safe.
Exactly. Gravity automatically drops the control rods to halt the reaction, and natural convection takes over. Hot water rises, cold water sinks, creating this continuous loop of cooling inside a massive pool of water. It physically cannot melt down.
That is incredible. And that safety profile fundamentally changes the economics of how we build nuclear power, because historically, nuclear construction has been a financial black hole.
It really has.
Yeah.
Traditional nuclear is plagued by a cost crisis because every plant is a bespoke, custom build on a unique piece of land.
Right.
It takes 15 years, and it inevitably goes billions over budget because of weather delays, specialized labor shortages, supply chain bottlenecks, you name it.
It's the difference between hiring contractors to build a sprawling custom mansion on a muddy lot over 10 years versus ordering high-tech, prefabricated modular homes that roll right off an assembly line.
That's a great analogy.
With the factory model, you know exactly what the materials cost, you control the manufacturing environment perfectly, and you just ship the modules on a truck to snap them together on site.
And that transition to predictable factory fabrication is why the forward financial projections look so radically different from the current cash burn.
Okay, let's talk about those projections.
The market expectation is that as Nuscale transitions from these initial engineering and design studies into actual steel-on-the-ground deployment contracts, their revenue is going to experience a massive inflection point. Analysts project top-line revenue will surge from roughly $30 million in 2025 to nearly $300 million by 2028.
Okay, the engineering is brilliant, the regulatory moat is deep, and the prefab factory model is highly logical. But having the best products sitting on a shelf is useless without buyers.
Very true.
We have to pivot from the technology itself to the demand catalysts. Who is actually going to sign the checks to drive a $300 million revenue year by 2028?
This is where the narrative pivots away from traditional municipal utilities into some incredibly explosive modern market verticals. We have to start with the White House.
Okay.
The administration recently established the National Initiative for American Space Nuclear Power.
Space nuclear. I mean, it sounds like something pulled directly from a sci-fi novel.
It does sound futuristic, but it is a very tangible, well-funded policy directive. The federal government recognizes that for deep space exploration, lunar bases, or, advanced orbital infrastructure, traditional power sources just fail.
Too much shadow for solar.
Right, exactly. Solar panels degrade and don't work in the shadows of lunar craters. Chemical batteries freeze or die. You need incredibly dense, reliable, persistent baseload power. This initiative explicitly validates the reliability and scalability of small modular reactors for these exact environments.
Okay, federal validation is excellent for long-term legitimacy. But I have to challenge the timeline on this. Space is flashy, but the multi-trillion-dollar artificial intelligence data center energy deficit is happening today.
It is.
The grid is bleeding right now. SMRs won't be rolling off the assembly line in massive numbers until the late 2020s. So how does this bridge the gap? Is the space initiative just a PR distraction from the real cash cow?
That is a highly analytical way to look at it. And the Space Initiative provides a fantastic sentiment boost and validates the tech, but you were entirely correct. AI data center demand is the existential crisis of the modern tech industry right now.
They need so much power.
They do. The hyperscalers are building out server farms so massive and so power-hungry that localized electrical grids literally cannot support them.
Which explains the incredibly loud rumors currently circulating regarding non-disclosure agreements with Tier 1 hyperscalers. We're looking at speculation pointing heavily toward Microsoft, Google, or Amazon.
These hyperscalers are backed into a corner. They've made very public, very rigid pledges to become carbon neutral by 2030. At the same time, their AI ambitions require gigawatts of new, uninterrupted baseload power.
And wind and solar just can't do that consistently.
They're too intermittent. They need nuclear. We've already seen a parallel deal in this sector where Oklo announced a partnership with Meta. The institutional bet right now is that Nuscale, holding the only actual NRC-approved design, is next in line to announce a massive hyperscaler partnership.
And the demand goes beyond just data centers. Reviewing the recent filings, their partnership with Ibarra Elliott Energy caught my eye. They're teaming up to provide process heat for petrochemical plants.
Yeah, the diversification into industrial heat is a massive, underappreciated catalyst. Traditional nuclear simply spins a turbine to produce electricity for the consumer grid.
Right.
But massive industrial processes refining chemicals, producing steel, manufacturing fertilizers require gargantuan amounts of direct carbon-free heat. By engineering their SMRs to provide industrial process heat, they're opening up a massive commercial market, completely outside of the heavily regulated, slow-moving utility space.
And layer on the macro environment, too. We're looking at rising oil prices and escalating geopolitical tensions, especially around critical maritime choke points like the Strait of Hormuz.
Absolutely.
Every time a supply chain threatens oil delivery, the government gets a stark reminder that domestic, carbon-free energy independence isn't merely an environmental goal. It is a critical national security imperative.
All of those factors, AI data, space infrastructure, industrial heat, and national security, converge to create a perfect storm of demand for their specific regulated product.
Which brings us to the elephant in the room. If the future is so undeniably bright with these catalysts, we really need to address the chart. The stock price didn't just dip, it collapsed.
It was a bloodbath.
Over a 6-month period, the stock tumbled 75%, hitting a brutal low near $9.14.
That severe drop was the mechanical result of the market pricing in the entry A1 failure we discussed earlier. When a flagship deployment partnership stumbles that visibly and triggers a $500 million accounting charge, institutional risk models automatically flag the asset.
They just dump it.
Yep. Algorithmic traders and risk managers ruthlessly sell off the position. It was a complete capitulation, washing out all the weak hands.
But then the chart shows a violent reversal. On April 16th, 2026, shares suddenly surged nearly 15% in a single session, hitting $11.78 on incredibly heavy volume.
Volume is the key indicator there. A 15% move on light volume is just noise, but on massive volume, it signals a definitive break in the downward momentum.
So the bleeding stops.
Right. Technical analysts see that surge and recognize that a new, concrete support floor has been established. It is also crucial to note that this stock has a high beta of 2.27.
Let's explain that metric for a second, because beta dictates how this stock trades. A beta of 2.27 means this stock is incredibly sensitive to market momentum, right? It moves more than twice as wildly as the broader S&P 500.
Precisely. High beta stocks are targets for algorithmic momentum trading systems. When the stock hit that volume node on April 16th, algorithms that scan for momentum instantly triggered massive buy orders, creating a self-fulfilling price surge.
Oh, wow.
That extreme sensitivity is why it suddenly appeared on retail big gainers lists, right alongside massive momentum stocks like Snap and Robinhood. It acts like a magnet for both retail and momentum capital.
Because the negative news was so heavily priced in, down at $9, Even a slight positive catalyst, like a headline about the Space Nuclear Initiative, creates a vacuum effect, causing these sharp upward gaps in price.
It does. However, we have to look objectively at the bearish signals which remain prominent in the filings.
Let me put my skeptical retail investor hat back on because the bear case here is loud. I see that an early backer, the engineering firm Fluor, just dumped 13.5 million shares.
A huge block.
Yeah, and even worse, I'm tracking class action lawsuits from aggressive law firms like Faruqi and Levi and Korsinski. They are alleging gross misrepresentations regarding the Entryway One partnership,
Right, the boilerplate stuff.
but they are specifically targeting the CEO and CFO with personal liability. When I read executives facing personal liability and watch early backers dumping millions of shares, every single alarm bell rings. How is this not a massive value trap?
It is entirely rational to see those red flags and want to run. But if we dissect the mechanics of what is actually happening behind those headlines, a much more nuanced picture emerges. Let's look at the insider selling first.
Okay, the Fluor situation.
Right. Fluor is an early strategic engineering investor. When an early investor sells a massive block after a long holding period, it's rarely a signal of impending operational doom. Usually, it is about their own internal portfolio, rebalancing, and finally taking exit liquidity.
So they're essentially just cashing in their chips after doing the heavy lifting to get the company off the ground.
In many cases, yes. And paradoxically, a massive block of 13 million shares hitting the market can actually be a positive for the stock structure.
Really? How so?
It drastically improves the liquid float. Many large traditional asset managers are legally restricted from buying illiquid stocks. Fluor selling provides the liquidity those big funds need to finally build a position, which directly leads to the bullish counterbalance. Institutional ownership remains incredibly high at 78.37%.
That is a staggering metric. Almost 80% of this company is held by institutions despite the 75% price drop.
Yes, and the recent 13F filings show significant new inflows from traditional asset managers like Audent Global and Keitong International. What this tells us is that while the early strategic money might be rotating out, the smart money on Wall Street views this post-sell-off price as a deeply de-risked entry point.
They're buying the fear.
Exactly. They watch the retail panic, look at the NRC monopoly and the AI demand, and aggressively buy the dip. Wall Street consensus targets seem to validate this, with a price target averaging $20.96. From a trading level around $10, you're looking at roughly a 100% upside.
And what about the lawsuits targeting the executives? That still sounds bad.
The lawsuits are certainly a headline risk, and they undeniably create a distraction for management. But they are practically a mathematical certainty following any massive drop in share price.
Ah, so it's systemic.
Yeah. Law firms utilize algorithms to find plunging charts and immediately file boilerplate suits, claiming investors were misled by whatever catalyst caused the drop. Institutional investors understand that these suits are largely performative. It is simply the cost of doing business in public markets.
Okay, we have thoroughly mapped out the terrifying risks and the massive potential upside. But if you're listening to this, you want a concrete playbook. You want to know how to actually navigate this setup chronologically over the next 3 months.
The overarching thesis here is a swing trade into earnings. You're essentially playing the removal of uncertainty.
Looking at the calendar, the first major date in the playbook is April 20, 2026.
That's the lead plaintiff deadline for the securities class action lawsuit we just discussed.
Why does a procedural legal deadline matter to a swing trader?
Because markets hate uncertainty far more than they hate bad news. Prior to that deadline, the scope of the lawsuit is an unknown variable. The passing of that specific date removes a massive layer of structural ambiguity.
So the risk gets quantified.
Exactly.
Right.
Once April 20 clears, the parameters of the legal risk are largely capped and set. The market can accurately price it in. Frequently, the passing of a deadline like this marks a definitive bottom for a distressed stock, allowing the fear premium to dissipate.
So you get past April 20, the legal overhang stabilizes, and your eyes immediately shift to May 7, 2026.
May 7 is the Q1 2026 earnings call.
Yep.
This is the critical juncture. This is the moment when management is forced to face the market, step out from behind the SEC filings, and provide tangible operational updates.
What specific mechanisms or updates are we listening for on that call?
You want concrete updates on their ongoing deployments, particularly the TVA project. You want firm commercialization timelines to prove the transition to the factory model is working.
And the catalysts, right?
Yes, most importantly, you're listening for any validation of those speculative catalysts. Any positive commentary regarding the space nuclear initiative or subtle hints regarding those rumored Tier 1 AI hyperscaler partnerships could act as a massive upside trigger.
It really all comes down to the psychology of the trade. Because the stock already dropped 75%, the market has essentially already priced in a catastrophic failure. The bar for success is set so incredibly low.
It really is.
Therefore, the company doesn't even need to announce a miraculous new multi-billion-dollar hyperscaler deal to see a massive rally.
That is the beauty of a de-risked setup. Merely surviving the legal deadline in April and then delivering a perfectly normal, non-disastrous routine operational update in May acts as a huge bullish catalyst.
Because the fear premium just evaporates. When the worst-case scenario fails to materialize, the stock naturally flutes back up toward its fundamental value based on that regulatory moat and the inescapable AI demand.
The downside is heavily protected by the recent washout of weak hands, and the upside is driven by a multi-trillion-dollar energy deficit that the broader world is only just beginning to wake up to.
That perfectly summarizes the wealth-building journey we wanted to take you on today. We've evaluated the brutal realities of pre-revenue balance sheets, the physics behind their impenetrable regulatory moat, the explosive macro catalysts in space and AI, and the psychological mechanics of trading the upcoming legal and earnings catalysts.
It's a lot to digest.
It is, but thank you for tuning in to evaluate the high-risk, high-reward landscape of Nuscale Power with us.
Before we wrap up, let's look at the bigger picture. This entire analysis raises a profound, paradigm-shifting question for you to consider.
What's that?
As artificial intelligence data centers and deep space exploration push humanity's power consumption to unprecedented, almost unimaginable levels, will the companies that own the physical, carbon-free energy infrastructure of tomorrow eventually become more valuable than the tech giants themselves?
Wow, that's a wild thought.
Just consider what happens to the balance of power in the global market when a $2 trillion software company can no longer build a new product or grow their revenue without first asking a nuclear company for permission.
A fascinating shift in leverage to think about the next time you use an AI chatbot. See you next time.